Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. And g'day, old mate. How are you?
Oh, mate, up and about. I mean, look, you know, world champions. That's all I can say. Oh. World champions in what's that game? Oh, T20. Oh. Yeah, the hit and giggle game. Oh, world champions. I'm on the bandwagon, mate. I'm on the bandwagon.
Mate, I haven't even seen the headlines. What's going on?
Oh, they won. They won the World Cup or something. It's called.
Yeah. Right.
Yeah. No. So good on them. That's great. Yeah. That's all I know about.
Why
cricket.
Is that on your radar? That's
well, you know, I'm not a big fan of the sport. Not necessarily. Oh, look, I like playing. I like playing a bit of backyard cricket, rolling the arm over, and you know, the sort of during the summer period. But
at your age, mate, you wouldn't be wanting to do that too much. You probably tweak it back or pull a hammy or something. True. So
anyway, that's true. I probably would do that, but no, good on them for they were. India was hot favourites, and they didn't even make the final.
Yeah. All right. Well, there you go. I better quickly go and have a look at the headlines because I'm not across that, so I can't get through. Hey, you're busy. AGM time, Ben. Tell us about it.
Yeah. So yesterday, last night was the Picker AGM, our annual general meeting. And so for those Picker members who weren't able to attend for whatever reason, just keep an eye out in regards to an on-demand copy of that will be available on the website for our members. And also we've got a webinar coming up. So also keep an eye out for that. And it's on estate planning. So some interesting conversations around asset protection and how you can go about doing that and effectively looking at how you want to look after the estate and what sort of legacy you want to leave. So, got to be a member, got to be on the database. You'll get the invite for that. And I think that's next week as well. So I just don't know whether it's the 24th or the 25th, but that's just gives you an idea to keep a lookout. So sign up for $5 or for $20 for 5 years, and we'd love to have you along to learn more about estate planning.
All the W's.picker.asn.au. There you go. So there you go, folks. And keep $5 in your pocket for next week, Ben, because we've got we're going to play along with all the Black Friday opportunities.
Oh, nice.
And
nice.
Our opportunity is going to be under $5. So, but the value will be significant. So,
can I play along with that too? I think I've got an announcement next week. I'm going to hold off on talking about it, but I've got a little bit of research stuff coming out as well. So,
can you beat me under $5?
I've got a couple of freebies, but there's also some paid reports.
All right. Well, $5. Keep it in your pocket for next week, folks. We'll announce that. But today we are going to do a little riff of a framework, you and I. It was a little sneaky one that I snuck into the life hack last week, and then you and I chatted during the week. And we thought, let's flesh this one out.
Yeah, it's a good one.
There might be a bit of gold for everyone to do. So we're going to talk today about why investing is so confusing, Ben, as we are in the shadows of the long break at the end of the year. Yeah, something for everyone to ponder on. But
love it.
Hey, my mindset minute today is largely around status symbols, Ben. So the BMW or the European car and the big house used to be the old status symbols, Ben. You used to, puff your chest out a little bit further and all those sorts of things, but it's not the status symbol of choice anymore because it's now freedom. So it's time freedom, location freedom, and financial freedom. So I just wanted that to land because we've moved, we've evolved, and everything that you and I talk about around lifestyle design is around those three things: time freedom, location freedom, and the financial freedom. So I just wanted to remind people, if you're still working to the old school status symbols of getting the biggest house you can and the European car and all that hooked up on credit, that is no longer the thing that you should be aiming for. It's passive income. It's getting your time back, Ben, so that you can go and be in any location that you want to be, and also just have some freedom to live the life that you want to. So I just wanted to remind folks that upgrade your thinking. And I want you to hang on to that upgrade your thinking, because I'm going to talk about that in my life hack a little bit later as well. But
nice. Can't wait.
Why, Ben, is investing so confusing? Why is it so confusing? Because I had a little look, and depending on which definition you want to roll with, Ben, I'm sure there's a billion definitions, but it's pretty simple. It's the act of allocating some resources, usually money, with the expectation of generating an income or profit. So it can't be that hard, surely. If that is all it is about, it can't be that hard. So we wanted to talk about today why investing is actually confusing. And it's probably helpful to break it into two parts, really, because there's one section that you need to be across, and that's the technical craft of investing. And then the second part, Ben, is the checkup from the neck up. It's the headspace. And to be honest, that's probably where the big game is played. It is between the ears. Because the technical stuff, and unless you get into derivatives and a lot of those paper assets that can be mind-bogglingly complex, it really is simple, isn't it?
Oh, I think, it's simple in the sense that it's easy to execute on. Where it becomes a little bit more challenging is the technical element of it. I mean, valuations of businesses, predicting future trends, inside those future trends, predicting the businesses that are going to win and the businesses are going to lose. And in a property sense, predicting where future demand will live, and where potentially people will reinvest in the properties that they own and increase the value of the dirt that lives underneath that. So yes, it's a combination of those things. I refer to it as the courage of your conviction in terms of, but how do you draw conclusions around, what's going to be done? And I think from my point of view, one of the big observations I've had, Bryce, in being fortunate enough to sort of guide people on a one-to-one basis is, and more broadly speaking, when I speak to a lot of people, is investing isn't for the timid, Bryce. Unfortunately, to invest, you need to be prepared for the road ahead. And that road ahead can show some gains, it can show some losses, it can do a lot of different things around your psychology. And, for me, speaking about my story, when I was investing as a 16, 17, 18-year-old in the share market and, potentially reading the quarterly production reports and on BHP, and then seeing that the share price go down and not understanding why, and and then sort of looking at it every day, and that just wasn't good for me in terms of I was never able to confidently say that I could do enough work around getting to the source of truth that allowed me to be an informed investor in what is technically meant to be an efficient market. That's the efficient market hypothesis, that the price is reflective of the value of the business at any moment and any time. And we know that that's not true. And so ultimately, that was where I struggled until I found property. And then I thought, actually, hang about, this thing's less volatile. I don't need to worry about it. I'm not seduced by a valuation each day. I don't need to know. And I can leverage that investment, and that's sort of taken me on the journey that it's taken me on.
Yeah, it's been an incredibly fruitful journey for you and for me both. But I want to hark back to the interview that we had with Julianne Cairns. I can't remember if you were in the States with me, Ben. I think Ivis was. When we
No, I was there for that one.
Oh, you were, weren't you? That's right.
Yeah,
so
that's right.
Was Ivis with us at that time, or was it just
you
and me?
I think she went that trip. Yeah.
And Julianne was, she was from New Zealand, and she came on stage and she talked about this tree. And I've never let the tree analogy, and we've talked about it a couple of times, but I think it's really powerful, because if we can if we can sort of envisage a big oak tree with a huge root system, she had this symbolic way of representing how investing works, is because the roots of the tree represents your beliefs, the soil that the roots are in represents your external influences, the trunk of the tree represents your internal attitude, and then the branches and the leaves represent the knowledge and the action. And I think it's a wonderful way for it to land, that we know that the strength of the oak tree is largely around the root system that it has. But if you don't have the root system, the tree won't be as strong as it is. And it's those underlying beliefs that are really important for us to tackle head on, because most of us water the branches and the leaves, but forget to water the roots. And also knowing who we hang out with and some of the internal attitudes that we have that we bring to it will actually affect our results. And the reason I say that is I remember when I was growing up, my mum used to work for a carpet manufacturing company in O'Connor in Perth.
Yep.
Or in more closer to Fremantle, to be honest.
Yep.
And her boss, I remember I used to go there, and my mum was working on reception, and there was the big boss with the big office, and he had the big fancy European car, and he had lots of money. And she used to always talk about, he plays, this is the language, he plays the stock market. And at the time, my mum and my auntie used to love going up to the casino, and they would play the card games, and my mum would always only have $20, but she'd just have a good time, and she never went any further than the $20. But it was this parody of playing up at the casino was the same as playing in the stock market. And I started to build this belief that the stock market was scary and a place that you didn't go, because it was just a big risk, volatile place that you put your money in, and there's no rhyme or reason why it goes up. It's just like gambling. And so over time, I had to undo that belief then, because now I know that it's largely around there is an element of outside of the control, but it's management structures and revenues and future cash flows and all those sorts of things that actually come into how you value a stock. And then you can use that to buy shares. And so for a lot of people who are not property like we are property centric like we are, they would swear blue in the face that the share market is the only way that you can build wealth. And we'll touch on that in a second. But the important foundation here is to remind everyone that the reason it's so confusing, I believe, is because of the basic foundation of some of the beliefs that we are grown up to be exposed to, that can sometimes be a work of fiction, that can be myth, that can be not rooted in truth. So you said it's not for the faint-hearted. And I think you're right. You have to embrace risk, right, to be able to invest. And there's certain areas of spectrum of where you can be. But I always remember Robert Kiyosaki teaching me, Ben, that risk is a measure of knowledge. So if you and I were to go out today with very little prep, we could probably feel really comfortable with buying an investment property in a very short period of time. Yep. Whereas for some other people, that would cause them enormous amounts of stress. It would cause sweat beads over their face, and it would cause them to lose sleep at night. And it's largely I guess a measure of knowledge. We feel very comfortable in our craft, so therefore we could make a decision to buy an investment property this afternoon with the same level of emotion that we would make the decision to buy a loaf of bread. Yep. So I just wanted to set the foundation from today that it's important to get that in our mind, because where the real game is played, in my mind, for investing is around headspace and beliefs. And if you don't get that right, that oak tree will not be built on a really strong foundation, Ben.
Bryce, there's one definitive, there may be more than one, but there's one absolute when it comes to investing, and there's one absolute when it comes to wealth creation, and that is you actually have to spend some money. Mm-hmm. So if you're going into business and you are a service business, you've still got to get yourself set up to run a service business. So you've got to spend money. If you're going into a goods business and you're selling goods with a margin on top of that, you've got to buy the stock, create the goods. That's an investment, that's spending. And ultimately, if you're looking to invest passively, you've got to spend money to make money. And that takes a level of, it's a fact, right? If you want to create wealth and if you want to build out whatever you want to build out, you're going to have to allocate an amount of money to invest or spend that money, pure and simple. And so if we know that that's an absolute, and then what we're going to be talking about here today is risk, reward, mindset, options, variations on a theme, as long as that lands for everyone, that's the beginning block. That's the foundation building block.
And importantly, I've been practicing what we preach here, Ben. I've been having some great conversations with the boys of late around money and value, and we've just transacted in a car. We've sold a car, and they were part of that, and why and how that works. And we bought real estate, so we bring them into the conversation. And it was really, and then we had the conversation around, hey boys, just be mindful about talking to others about money as well, because you don't want to put yourself in a position where you create jealousy and all those sorts of negative things that can come from comparison. So I quickly just got a piece of paper pen and reminded myself at the same time as Jack in this occasion of the Cashflow quadrant, with the E at the top left, the S at the bottom left, the B at the top right, and the I at the bottom right. And just reminded him that employee, self-employed, business owner, and investor, as a family, we've been spending a lot of time getting ourselves on the right side of the quadrant so that we can have a business that has a system that runs the income rather than being in the bottom left, which is self-employed, which I have been over time. And a lot of people are in the E quadrant, but ultimately the goal is to get on the right, to have business that has a system running it. The goal is to not know the alarm code because you have people and systems and process and procedures running the business instead of yourself. And then clearly this podcast has been about getting people into the bottom right quadrant to be that investor, to get to get your money working harder for you. So what are some of the things that people can invest in, Ben? Well, we've talked primarily about setting this up through financial means and the definition that I gave for financial means, but it's also not always just about being about financial means, because you can invest in different things. Like you can invest in friendships, you can invest in family, you can. We had Simon Kustermacher on this podcast a couple of times. We had him speak to our team at our conference earlier in the year, and there was a graph that he put up, and he said very clearly that the investment in education provides you with enormous dividends in terms of the amount of income that you can earn. So investing in your education and your job before we get into different asset classes. So there are a whole range of things that you can put your time and your energy into investing, Ben.
Yeah, look, the one for me, the education one is really powerful. But we also want to remind people that, like if you're young and you're listening to this and you're coming through your teenage years into your sort of first job, and there's a lot of pressure on, just what sort of qualifications and those types of things that you're getting. And you want to have tension on that conversation, but you also want to, let people know that it's not going to define you. In that early stage, you're going to have multiple career options. There's going to be different ways in which you can do that. So a natural curiosity about how things work is going to put you into a terrific position. So long as you don't just have a bird's eye view of something, you do need to get a little bit deeper into it to build out your skill set, so you can get to that sort of, expertise level, the 10,000 hours type level. If you're going to do something well and be successful at it, there's no real shortcuts. People can get lucky, they can win lotto, they can do a few other things, but the real, the true results are really done by those people who basically put the effort in and the work into it. Is pretty much my takeaway in that space.
Yeah, and you're right about the education. It doesn't necessarily need to be formal education either, Ben. It just needs to be a student of life, and a student that where podcast, books, YouTube, all that sort of thing is just as helpful. Because if you're trying to get to the right side of the quadrant and understand, say, the B, running a business, there is a book that I've read that I thoroughly recommend called The Personal MBA by Josh Kaufman.
Yes.
And it synthesizes 3 or 4 years of an MBA into a book. That is not just your classic textbook style, heavy cognitive load trying to get through it. It's actually really enjoyable to get through this book. And just to give you an example, Ben, it synthesizes any business down to any business in the world. If it doesn't satisfy these 5 things, it's a hobby. Number 1 is you've got to have value creation. Number 2, you've got to have marketing. Number 3, you've got to have sales. Number 4, you've got to have value delivery. And number 5, you've got to have finance. If you don't have the 5th one, finance, it's just a hobby. So something of value that someone wants, a marketing team to actually get the attention, a sales team to actually get someone to buy it, a value delivery team to make sure that you deliver on the expectations, and the last one being finance to make sure that you do it in a way that makes it rewarding for the risk that the shareholders take on to do it. Otherwise, go and do something else, right? So just there, a whole business has been broken down into 5 things. That is just one of many synthesized frameworks and ideas that come from out of that book. And then in the setting up of the book, it talks about how if you have to mortgage yourself, and it's largely an American based, if you have to mortgage yourself to go and get an MBA, and the opportunity cost of what that is, paying it back and then getting the money to get back to break even. This book literally does give you an MBA exposure. So it's not just about formal education, folks. There are a number of ways. If you work hard, you build a habit, and you are hungry, you don't necessarily have to go on the formal channel. Notwithstanding, Ben, the formal channels are wonderful, right? So I'm not trying to belittle that.
Oh, yeah. You get the right lecturers and the right professors and the right teachers, and, the people who have walked a mile and seen a mile, and they've they've literally diagnosed patterns and formulas into certain framework. It's mind-boggling in terms of how powerful, Drucker's, assessment of, successful business, the 5, irrefutable laws of business. And there's a lot of, incredible sort of stuff out there for those interested in that space. So, but what I will say is from when we went through school, and as you know, Bryce, I'm a little bit older than you, we really only had books and a really limited avenue to education. I tell you what, with podcasts and with YouTube, and there's so much amazing, and Google, there's so much amazing information that's at your fingertips. So if you wanted to dedicate time into a particular subject matter, you can get lost into that subject matter in a good way, in terms of, and always, when you do start to form opinions, see if you can find some counter opinions out there, so you can balance that assessment, because there are also a lot of spruikers in that space as well, right? Who are interested in putting content out there and telling you, like we talk about, 80% of the truths, which all sound good, but just fail to tell you that 20% of the critical, in terms of what you need to potentially execute. So, but I'm really, I'm pleased to see that being decentralized, and I'm also pleased to see more people, younger people, looking at alternatives other than bank deposits and high interest rates to basically look at ways in which they can get a return on investment as they're saving for a deposit for a home or whatever their intentions are.
You make a good point, Ben, because I remember when I first got involved in the first property club that I started out, it was at the Mount Claremont Recreation Centre, I think, and it was just a hall. I went in there. I was really nervous. I was 23, and I just wanted to be around. I just wanted to have that osmosis feeling of being around other people who wanted to talk the language I was talking. Because in my family tree at that point, there was no one that I could riff with, and my friendship circle wasn't in that space. So I was hungry to go and find an audience of people that I could spend time with to learn this stuff.
Yeah.
And I remember walking in, and I've said this before, so for some people who've done a lap, they know this story, but it was one of those old school projectors where you remember the plastic clear slide. I can't remember what they're called.
I've got it. Yeah, the
overhead projector. That's it.
Yeah,
so you get these, and it was in a lever arch file, and they'd pull one slide out and pop it on top and position it. This is before PowerPoint, and then they'd pull it off and they'd put it to the side and they'd grab the next one. And I was so hungry, Ben, and I went to every meeting. I was hanging out with people that were 20 years older than me, but I just wanted to, whereas now, I spend a bit of time on YouTube, Ben. I try and get as many macro trends as I can, listen to as many people. And mate, there are so many 30-somethings with hoodies who are riffing stuff that is phenomenal. The amount of intelligence they have around macroeconomics from a global scale, not even in their own little pond. So free, and just you don't have to travel to a meeting venue. You don't have to wait until Thursday night at 7:30, and if something happens, you can't turn up. And you're so right. So, but the challenge so I was chasing the information age. What people have to chase now is the insights age, where they actually can digest all of the stuff that's out there, because it is, the topic of this podcast is it can be confusing, right? So you need to be able to have a number of mental models, which we're hoping to give our community, so that they can filter the information in a way that enables them to work out, is this person someone that I should be listening to their information or not?
Yep.
And that is now the new challenge of the current millennial, rather than back with when you and I had. It's just where are these people hanging out? This was before the internet really kicked off, so it was really more difficult to rub shoulders. Whereas now, we got people on groups on Facebook that can hang out from all around the world talking about the same topic. So it's definitely a different environment that you and I grew up in compared to what it is now.
Totally different.
So you can invest. Different people invest in different things. So clearly there's some investments. But then when we talk about the investment products, so we talked about some non-investment product ideas there.
Yep.
But even if we just talk about shares, let's just say you're a shares person.
Yep.
Well, Ben, it's mind-boggling the sort of the subcategories of shares that you can start to invest in, right?
Yeah. Look, I did my apprenticeship of going and doing a share trading course in my youth. A long time ago, I learned about stop losses. I learned about basically trading systems and how the trend was your friend, and
yes.
How you can put all of those sort of ATRs in place. And so effectively what you're trying to get is the top, but you'll never get the true top, but it'll cut you out because you're running a formula that will allow you to work out when it runs in a certain pattern. And so you want to try and get within that pattern. So look, a lot of interesting stuff in that share space, and obviously a lot more has evolved. Summarizing the simple stuff, from an investment point of view, you've effectively got, a growth type of principle or a balance type principle. So when you're thinking about, investing 101, you're either going for, yield, or you're going for growth. And so that's where you start to work that out based on your risk profile. That's, again, the very, very simple stuff. You'll see, I've said this before on our podcast, Bryce, you will, if you are great at picking shares and trading the stock market and doing all of those things, and you pick Amazon an example and Google example when they first started out, that is transformational for your life, right? I mean, property will never, ever deliver you, and I'll say never, ever deliver you the percentage returns that you will get through a share in a company that basically breaks through into unicorn status, goes from a small cap in through unicorns and comes out the other side as a mega business, right? So that is true, and we've never advocated otherwise. And I'll probably also make the point here that we've also never advocated that our selections and our recommendations that we make are guaranteeing us a return, or we're guaranteeing that this is the best buying opportunity in the marketplace at that moment in time. Anyone who uses that type of language to say, this is it, this is the one thing you must do, is spruiking to you, and you want to be careful of them. And secondly, how do they know? I mean, the best commentators are basically say, here's my thesis on why the market's going to do what it's going to do. Yeah. And it's backed up by these considerations. But hey, look, most of the world's economists didn't have a problem with how, basically cheap money in 2007 was not going to cause the global financial crisis. I mean, you've got Ben Bianchi and you've got people on record, Alan Greenspan, all of those people right through that period who have said, oh no, there's nothing to see here. We don't think it'll be a contagion. There's nothing a problem. And then we had a complete global financial meltdown on the back of, these contracts, CODs.
CFDs.
Sorry.
Contracts for difference, CFDs.
Thank you. Contracts for, and all of this, sophisticated money, security plays. And so for me, it's like, just be mindful that do your research, do your own research is probably my best advice here. Because if you're taking advice from somebody else, you do get yourself into, if they're not professional, that is, if they're professional, hopefully they're qualified to give you that advice and they're giving you all the supporting information attached to that. But be very careful to be listening to a commentator who hasn't walked the talk or been there. But even if they have, they might have got there early, and all of a sudden it's going to end in all manner of strife. So it's quite fascinating in terms of how people react to that and how we move in groups and communities. We call it sheep movement. And
we're tribal in nature, aren't we?
Yeah, that's right. And when the cab driver's telling us we all need to get into crypto, well, that's probably when we all should be just making it, taking a second look at it, as opposed to jumping in there blindly. And I think that's important.
Hey, Ben, you said one thing in particular around the thesis. And I think I really want to lean into that, because I think that's really important, because it's a fancy word for just saying an overarching principle of what you believe to be the case. So for us in property, we believe that the demand for property will increase in this country, given the fact that we settle largely on the coasts, in some major population centres, with a little bit of escape to regional, which we talked about, but largely in those big urban population centres. And part of our thesis is the fact that we are an attractive land mass worldwide for other people to want to go, I want a bit of that. That place down under looks like, with the exception of Victoria, with their political leader, look, that place down there looks like that's a fun place to be with good quality of life. And so that's our thesis, that the demand for bricks and mortar in this country is culturally ingrained. And part of our thesis is we don't see that changing. And part of the thesis is we see lots of people being attracted here. So that's the bigger bit. And then everything that we teach on this podcast then becomes first principles, right? The principle of location does 80% of the heavy lifting, the principle of there's 5 steps to actually do it, all the principles that we've talked about. And I think that's really important, that if you are into shares, or you're into art, or you're into whatever it is, or property, to develop that overarching thesis, so that when you're feeling wobbly, or someone questions you, or there's negative news or anything like that, you can always go back to your original thesis. What was it that gave me the confidence to be in this particular asset class in the first place? Yep. And then if I apply first principle thinking to that, will that give me the confidence to withstand any of those short-term wobblies that you might find yourself coming across? So I think it's important. You raised it as a throwaway, Ben, but I think it is super, super important that our community understands they need to have an overarching thesis for them to feel confident in the asset class that they choose.
Yeah, look, I couldn't have said it better, Bryce, in terms of it's an understanding. I mean, if I'm coming back to the share story there, if I'm saying that that in property you should never sell, and we've pivoted from probably earlier episodes where we said never sell, just hold. There are,
hardly ever sell.
Hardly ever sell. In the share market, my observation of that market is that position is not necessarily a wonderful position to have. And now I would say that on balance, if you're in a great company, you want to continue to follow the trend of that great company. But I also know that there are examples of, cyclical stocks, mining stocks that have really great runs, and then they effectively give up some of that momentum and their share price is adjusted accordingly. And so if you're willing to put the effort into, looking at, the trends and the balance sheets of those businesses and the production levels and their PE ratios and, and how they're setting up for their strategy and their business, you could probably see that some of those businesses are going to hit headwinds. Our big banks are the same. So there are people who will happily sit on Rio shares or BHP shares or CBA shares or CSL shares. And I put myself in that position as well. In terms of, there's some stocks that I've held for a very, very long time, but I can also argue that if I'm true to my conviction around that I want my money working harder for me, there are definitely reasonable times that you would consider taking profits in that particular market. Now, again, I am not an expert in the share market, but all I can tell you is that if I look at the businesses that underpin that share market and having, run a reasonably successful business with you and the team here, there's things that you learn along the way in terms of you're going to have really great periods of growth, and you're also going to have some consolidating periods, which are going to impact profitability and impact the share price. Or the value of the business, which correlates to share price when we're talking about public listed companies. those types of attributes should also be seen as part of that story. And in business, you're predator or prey, right? So from that point of view, what I mean there is that some businesses grow organically and some businesses grow through mergers and acquisitions, and how they merge those in, what price they pay, how all that looks. There's plenty of studies that have assessed the successes of mergers and acquisitions to very mixed results, I might add, in terms of share value destruction versus share value addition. And that's the nuance. That's the science of what it's like if you're going to play in investing in businesses, whether again that be sort of your own business or private businesses or listed businesses on the stock exchange.
Even think about the Lehman Brothers, Ben. Even in the lead up to probably about a year out, the share price was doing really well. The actual CEO, Dick Fold, had took $500 million in remuneration out of that company at the time of being involved. And they'd packaged up those securities and put them out to the market. So the people who were buying the securities were so far removed from actually what they were. So it was looking pretty good.
Yeah.
Everything was running super well. And then obviously it became a house of cards. So, but that was on the back of you saying if you had stayed in that stock forever, you would have gone from a lofty high to being worth not very much at all. So again, we're not trying to discredit shares in any way. It's just not our expertise. So if you want to invest in shares, go and speak to someone who is an expert in it. And Ben and I both have shares, so we're not saying it's not it's a no-go area.
And through your super, everyone, you're also investing in shares. So one of the, if you're not familiar with what your super fund is investing in, whether it's an industry or a retail fund, please take the time to understand whether you're in a growth fund or a balance fund and what's your blend of investments they're investing in. If you want to make every dollar work harder for you, you're going to have to take an interest. You can't just expect that you see an ad on TV and says over the X number of years we've done this, and so that's going to continue. I mean, a lot of the industry fund growth has come through building stuff, mainly commercial buildings. Well, if there's a change in the way in which we work, the rent on those commercial buildings, if that is impacted, then the valuations of those businesses. So there's a lot of, sort of different sort of elements here. You've got ethical investing as we move through a real climate change focus and renewable energies. You've got robotics. You've got all of these different sort of mega themes that are coming through, security, cloud. So I do see, some opportunities there. But again, if it is to be, it's up to me to be able to make an informed decision and ultimately own that decision, through my own research.
So we've gone through, you can invest in different things, and then there's different investment products. So we've just labored a little on shares. You can get bonds, Ben, which is a bit more secure at times, depending on what yield you get on that. Residential real estate. I don't think we need to expand too much on that, based on the fact
there's a few other episodes on that.
The topic. Property couch. Clearly, you can invest in insurance, which is a defense play, which is a big part of the conversation that we have here. Commodities. You can put your money into commodities and a whole range of things, right? And interestingly, for folks, back in 1971, President Nixon unpegged the American dollar to the gold standard. So they used to have the amount of currency that was on issue at the time was equally matched by the amount of gold that was in the reserves. And at that time in 1971, unpegged. So now you've got this floating currency, which is the global standard, which no longer has any backing, which means the Federal Reserve can just go into the database and print some more money, which there is a fair bit of dialogue if you go and have a look around what that will mean to the economy. But I guess without going too deep on that, for us, the fact that you have a tangible asset that is an essential need when you're in property can be a hedge against some of that stuff that's going on. But so you go from investing in different things to different investment products, and that's not exhaustive, to then having different investment procedures, Ben. So
this is where it gets important.
Yeah, it gets super important. So we'll riff off the headlines, and then we might have a little deep dive. But you can buy and hold, which is considered going long.
Going long.
You can buy and sell, which is considered trading. You can sell, then buy, which is considered short trading. There's dollar cost averaging, there's brokering, and there is saving, just to name a few. So let's have a little conversation around that, Ben. Which one do you want to kick it off with?
Well, I think I mentioned earlier before about, the sort of approach to the different asset classes. I think you want to be looking at your approach. Not only, first of all, you want to be setting up, okay, what sort of risk profile do I have? And the other critical thing for me is how much of my wealth do I want to put at risk? Okay, one of the things that when you're younger, there might be an argument that you're happy to take on a little bit more risk. So you might have a growth mindset, and that's allowing you to do that. But I still think it's really important that you diversify that you're not a one-trick pony, in a simple sense. And then as your wealth base grows, you can then start to take more calculated risks on the percentages that you have. So once you've set up that framework, then it is about, okay, so in property, I want to go long. In shares, in blue chips or whatever, I want to go long. Probably not a bad bet to go long on some technology businesses, even though they do feel a little bit overpriced in terms of PEs. But these businesses are global businesses with incredible penetrations and distribution at very, very low costs and high margins. So they're very fascinating businesses. The short selling one, so that's basically the sell then buy. That's a sophisticated instrument. You're effectively betting on the deterioration of that business. So you want to be careful there. We haven't put an option calls in here as well, but they're also in there.
Well, the derivatives, right? So, but interestingly, Ben, with the with coronavirus kicking off, just so people understand short selling, the people who are sophisticated, when coronavirus kicked off and the stock market lost its pants in a hurry, there's often the saying that you can make more money in a crisis than you can in just general market conditions. So what would have happened is the people who've been playing the game for a long time, who had an advanced knowledge position, they would have just started short selling. They would have sold stocks, blue chip stocks, which means that they get the money for selling, but to close out the position, they've got to buy it. So they sell it high and buy it low, and they make an extraordinary amount of money in a quick amount of time, Ben. So
if they get it right, or if you want to look at Tesla, where that was one of the most shorted stocks, 2 or 3 years ago, and they got it woefully wrong. We had some hedge fund traders come into Australia. I'm going back, I think it's probably 2012, 2013. They did a show on 60 Minutes to try and show how easy it was to get money. And they were trying to basically short the banks, right? That didn't go too well for them either.
And which is why they was getting the international headlines, Ben. So you've just given insight as to why these international economists would come and say our property market was going to go to custard. It's because they were going to benefit from the banks' stock price going down.
And I think that's a really important point, that you need to understand when things are happening, what's the agenda? What is the reason that, that these macro influencers or these big companies are trying to do what they do? Because everyone's got an agenda, right? Whether it be to make money or make the world better or, improve themselves. Just understand it from the context of where they're coming from, and you'll do really well. The dollar cost averaging one, I think that's a really sensible one for people who are allocating money aside where they can build momentum, and then that sort of smooths out the variations. Certainly if we're thinking about share trading again, or share purchasing, not trading, that when, so you buy, if you consistently buy on a similar day, you're basically smoothing it out over a long period of time. And hopefully if the trend is your friend and you're seeing a northerly direction of that trend, that's going to put you in a reasonable position over time as well.
If you're going to spend $500 a month, Ben, on shares, you just spend $500 a month. You're not sitting there trading the price, because over time your 500 will have bought a lot because the price was down, and over time your 500 buy less because the price is up. But the point is, it's a method to make sure that you build a James Clear habit of getting your money into the market, rather than trying to, when you're a kid and you're in the playground, you're trying to get in the skip rope and you just keep waiting for your turn to jump on. Oh, next one.
There's that courage of conviction.
It's kind of it eliminates that behavior of people just consistently making sure they get in rather than trying to play the price game. So you can broker as well. You can make money by brokering other people's money and taking some margin, but you've got no position on that. And of course,
and be careful on leverage, people, and CFDs in that sort of space. It can wipe you out if you don't know what you're doing. If you're not a sophisticated investor, I wouldn't be going anywhere near leverage in some of these markets. Just walk a mile, see a mile. Be careful, people.
Yeah, and then you've got savings. So therefore, Ben, if we go back to why is investing so confusing? First of all, you can invest in different things.
Yeah.
Then there's different investment products that you can put your money into, and then there's different investment procedures. And then you're the next thing is you're an investor that's classified by procedures. So you could be a share trader, a house flipper, a coin collector, a futures trader, a day trader. You could keep your money underneath the bed. You could keep your money in the bank, and then within residential real estate, Ben, you can be a buy and hold. You can be someone who is renovating and short-term flipping. You can be someone who's developing. So again, within all the categories, you can categorize yourself as something else based on which one you identify with, which matches your risk profile.
I'm going to identify myself here, Bryce. Can I classify myself?
Yes.
85% of me is a boring conservative investor. Yep. I'm boring. Well, if you've listened to my story, I'm really boring.
Building passive income by 50 is really boring, mate.
Yeah, but that's not only, boring as in sort of the financial returns. It's probably just boring as a bloke. But the other 10% to 15% of me is active and looking for opportunity, and curious, just generally curious. So I can always know that when I'm, there could be 5% of my portfolio at risk at any time in some more volatile things. Plenty of winners and losers there in terms of penny stocks over the journey, and a few other things. But look, I'm interested in it. Just generally interested in some of the private businesses and startup businesses that are coming through. That sparked my interest because I might be able to add some value, to those businesses. But that defines me. So the vast majority of everything that I do is planned out. It's very clear. It's based in cash flow analysis. It's based in historical performances. It's based on information and knowledge that I have. And then there's the 10% of me that's playful and willing to take a punt, some more calculated than others.
Yeah, likewise, Ben. I'm most of my, I say if you want to get your kicks, just go in, bungee jumping. Don't do it through investing. So, but some people want that. I've got a fascination around turning apples into apple pie, and that's more of an interest. I love transforming old properties into something better. And adding the value. And I haven't early on I got involved in property development. I haven't done a lot for a little while, but I still find it interesting. But it's not a part of an investment approach. It's just something that intrigues me and that I like getting involved in. But ultimately, I can declare the same thing: been boring, conservative approach to investing. So you can be classified by procedures, and then Ben, you can under a banner of investing, people are speculators, traders, gamblers, savers, losers, and dreamers. So within property, speculation is interesting because there's so many ways that people can speculate. But the one that we find the scariest is where you have off the plan speculation, because you are literally buying a concept, and that concept has so many variables involved in it that there is very limited recourse for the poor old buyer, because the developer prepares the contracts to their advantage. And if you're in a rising market, we've talked about sunset clauses. So, but Ben, how would you sort of provide guidance on our community around these categories of speculation, trading, gambling, saving, losing, and dreaming?
Well, we talk about the sort of 5 types of property investors, and I'll see if I can reel them off the top of my head. But you've got your basically your passive investor, your active investor, your active weekender, sort of your project manager, and then what we would call your pure investor. And so when I'm looking at those types of things, I'm trying to understand how much interest and how much effort do you want to have. For the real active person, they're gonna basically get in there and be hands-on and turn apple into apple pie. And we talk about that as it's not really an investment return. That's using your physical effort to build out something like that. So that's not your classic investor. Your active weekender and your project leader are also trying to do that in terms of coordinate or basically a bit of elbow grease in terms of building wealth. The passive investor for me has always been my happy space, because it allows me to be looking over the fence and making sure that I've got an understanding, and and if I'm working with professional partners, I'm holding them accountable and asking the right type of questions and hopefully getting the right type of answers that I want. And the pure investor runs the risk of basically outsourcing everything. And when they do that, then if they've picked the wrong team, there's a lot of blame and that goes with that. And it's almost like, well, the biggest blame should be the mirror of you looking at it and saying, well, I actually let this happen. I was the one that picked them. I gave them the money to invest with. And so now that really is on me. And if they don't change that mindset, then ultimately, they'll continue to keep throwing money away at the next big thing or the next big fad or the next person who's got a convincing message.
Yeah. Outsource the execution, but don't outsource the understanding is the mantra on this podcast. So that's the pure investor could essentially outsource the understanding, which is not always, but could, and which would amplify what you just talked about. So, all right. So then you can have a different position within the banner of investing, and then Ben, you can have a bias.
Oh yeah, this is go through them.
Well, the share trader could say equities are the best, and the property person says no, real estate is the basis of all wealth. And one of the things we always say, you look on the rich, the BRW Rich 100 list, the foundation is generally in property, Ben. So that's our bias, right? And then someone who believes in gold before 1971 and now thinks that that's still the best one, that's where to go. Or alternatively, they could say it's obsolete. Put all your eggs in one basket. Don't put all your eggs in one basket. So there's all these biases, Ben, which you and I definitely have biases too, that we've declared.
Everyone has them
on this podcast, that we think that stability and the lack of volatility and the predictability that comes from residential real estate is what we love. But you only have to be at a barbecue, Ben, to bring this up as a topic to realize, wow, there's some biases flying around here.
Yeah, look, everyone has them. We're human beings, right? We're not perfect creatures. We're not perfectly informed at any moment in time. We have anchoring biases. We have sunk cost biases. We have confirmation biases. We go looking for things that reinforce our belief systems. We do all manner of things in this particular space. So even though we're having a lot of fun with these sort of, headlines and sort of pigeonholing, the reality is that they're not really defining you. And if you want them to define you, I think you're missing the point here. The point for us is just about being educated and being informed and understanding what your biases are. I mean, I can tell you, Bryce, that I've stressed over buying 20 years ago, I would have stressed over buying the right phone or even a CD that was on sale where I thought it was value versus where I thought it wasn't value. And then I could have turned around and spent $2,000 on BHP shares with less effort and understand. And here I am, as someone who prides themselves on getting into the numbers and getting into that cognitive effort to be able to, so a lot has changed in my life over that time, but it just goes to show you that you can do certain things, and you look at costs and money going out. And then you look at investing and you think, well, that's money coming in, so I'm not going to do the same amount of effort and research when you should be. And we're all guilty of that. I mean, I've made money on shares that I've thought for 2 seconds about. I've lost money, a lot more lost money on shares that I've thought for 2 seconds about. And I've also, done a lot of research on certain things and done really well out of those shares that I bought as well. But I think over the long term, this is a probability game. And so if you're more informed with your research and your thesis, and all of the data points are confirming that and not pushing away from that, then, if you execute over a longer period of time, you're going to be in reasonably good shape when you come up for air.
Yeah, and if you even think about some of our biases around the top of the mountain, Ben, with the $2,000 passive income, our bias is a buy and hold position with a debt retirement bias.
Yep.
But there's also others in the marketplace that say, yep, buy and hold, we definitely are, but just borrow against the equity to service your lifestyle. And so you have this growing debt, but you also have the increase in value growing at a much faster pace than the increase in debt. So their bias is, don't worry about retiring out the debt because the portfolio will service you. And then you talk about my original mentor, if you go back to Jan Summers' book, was buy and hold and then sell some properties because then...
to retire some of that debt.
So there are a whole range of biases within even our strategy, which is buying and holding long-term residential real estate in your portfolio. So that bias is really, really important. And to understand, even if you go back to my share market story, where my mum's boss in the carpet manufacturing business, I had a bias that it was dangerous, highly speculative, and not based on anything other than the same as pulling a slot machine at the casino.
Yeah.
So that was my bias. And then I had to undo the bias to make sure that actually that's not true. It's just it was based on incorrect beliefs at the time. So we go through the bias, and then finally, Ben, if we actually make it through to this far as an investor, we've gone through the confusion and the haze, and then we get to the same product but different directions. So let's think about the residential property market right now. Some of us think there is still room for the property market to increase in value, Ben. And there are others who think we are fully tapped out. The debt to income ratio is beyond what is manageable. This is a house of cards that is about to tip over. And all of these people who bought all this residential real estate are going to come undone. So there is two narratives going on within the very strategy and the very bias that you and I are talking about. So that is something that people need to navigate.
Economics is a social science, everyone. It's not it's interpreting and understanding movements and patterns of behavior in a way, right? Ultimately, the sum of all of the activity that we do inside Australia and what we export and so forth makes up our GDP. Now, when it comes back into perceptions and moods around, market keeps going up, market keeps going down, that is, again, if that perception and that trend changes, then ultimately the result of that is that we move value. I mean, value is based on a belief of trust that something is worth something at that moment in time. And the whole system is built on basically, if we're getting really big picture here, it's built on storytelling and a belief system that we live in a society, and that society has a framework, and that framework has laws, and that's how you build a society and an economy in that way. The only true science is biology, right? That's a thing. You can touch it, you can feel it. So when you're getting into the social sciences, and when you live in societies that have those types of mechanisms to create markets, then you need to understand that if everyone was to think that the share market was overpriced tomorrow, then shares will fall. I mean, it is it's a popularity contest that runs, and then over the longer period of time, it's a mechanism as a voting machine, right? I think that there's some really interesting stuff to be said for the trend being your friend, but ultimately, like anything, they move in cycles.
So to borrow the equities or the share market terms, Ben, if you think the market's going up, it's the bull.
Yes.
You're a bull. And if you think the market's going down, it's a bear. Obviously, the bear is a hibernator, and the bull is someone who's on the tack and heading for the red flag. So, folks, if you've been wondering why investing is so confusing, it's because you've got to go through investing in different things. And then once you've determined the products, you've got different investment products. And then you've got different investment procedures, and then you're classified as an investor by those procedures. And then under the banner of investing, people identify themselves with different labels. And then once you get there, you have a bias as to my sandpit's better than your sandpit, and no, your sandpit's not as big as my sandpit. So we get to that sort of stuff. And then once we get into the, let's assume, Ben, we're all in the same sandpit. Someone thinks that the sand is running out, and someone thinks that there's plenty of sand left to go. So there is a lot of stuff that you need to be able to synthesize to get down. Now, Ben, I think it's useful to end this week's podcast in the same way that I ended the life hack last week when we brought this framework up, because I think to help you, it all comes down to modeling something that works and being really clear on what actually works. So the first thing is to actually find a mentor, whether it's real or virtual, that you can identify with, who's actually achieved some results that you want to achieve, and then set about understanding exactly what they've done and copy them. Yeah. Because if you copy them, if they've already set the path before you, pioneers have generally got arrows in their back. You just follow someone who's pioneered before you. I did. Jan Summers. She was well and truly the pioneer for me, and I just copied her. Now, as I've developed skills, knowledge, and understanding over time, I've been able to refine the path that I take. But at first, it was simply copy. She got up on a whiteboard, Ben, and she said, "The tenant and the taxman will pay most, if not all, of your bills." That is quote unquote what she said on the Ray Martin show when she was riffing it with the whiteboard and the black pen. And I remember at the time going, why isn't everyone doing this? I just want to do what she's doing. And I set about doing that, Ben, and I was meticulous about doing that. So if you think investing is confusing, that is why. There is a lot to decipher, but ultimately the pathway at the top of the mountain is find someone who's done it and let them act as the Sherpa that gets you to the top of the mountain so that you get what you want. So
and your mountain is your tailored. So take the pieces, guide you. Ultimately, it's still a tailored solution for you. So don't try and be tagged or pigeonholed into anything. Bring all the best bits with your team of advisors and yourself on your journey. And so start, as Bryce said, follow, copy, you take their feedback, but then start to work out what's working for me, what's my plan, and what's my mountain that I'm going to climb. Because once you correlate that back to goal setting, your destination becomes really easy and your pathway becomes clearer. So destination of the final, climbing that mountain, how big is it? What's it going to do and then what's the pathway to get there? And then you'll be able to, look back on that journey and go, that's it. It was still for me. It was all about me and what I wanted to provide for myself and my family and loved ones and friends or networks or what contribution I wanted to make. And then ultimately you'll find happiness on this pathway.
Yeah, well said, mate. Well said. So there you go, folks. Hopefully that's given you something to think about as you go into your weekend about why investing is so confusing, and hopefully give you some, some filters and some frameworks and some ways to synthesize all this information so that you can actually find a way out. Because the truth is that it's actually a simple path that you need to navigate if you are prepared to put some time and energy and effort into understanding it. And also on the other side, you've got to understand how to overcome some beliefs that might be holding you back. But hey, my life hack today, Ben, is how to look after your brain. I hinted at it when I was talking about Mindset Minute.
Yes.
But it's kind of just a way to think about how you look after your brain because it's a super computer and it's important that we do. So first of all, you've got to update its software, right? So that's through reading books, listening to podcasts, and enjoying experiences. That's how you go from iPhone 3 software to the latest software, by doing some of that, Ben.
Yep.
You got to protect its battery. So the way you do that is you get 8 hours of sleep, you connect with nature, and you look for opportunities to technology detox. And the last thing you do is you've got to clean its hard drive. So you've got to meditate, journal, and have some really positive self-talk. So my life hack today, Ben, is to see your brain through the eyes of a supercomputer so that you can update its software, protect its battery, and clean its hard drive, because it is a supercomputer, so we should look after it.
Mate, I love that one. Where is that your own creation? It's a ripper.
Yeah, I just trawl around looking for different ideas, Ben. So
I like it. I like it.
There we go. Hey, what's making property news?
So, mate, there's a couple of good, important stories that I wanted to address today. And we'll put the first one in the show notes because there's a really good presentation by Dr. Philip Lowe, our Reserve Bank governor, talking about inflation and the recent trends with inflation. I'll summarize it for those of you who are time poor. But basically what he's saying is that it is transitionary and it's on the back of basically being locked down where we normally would have bought services. We've now bought a lot of goods. And that has obviously created lots of demand for those. And there's been obviously supply chain shortages. And that's played into, especially with businesses where they have on-demand inventory. So the world is struggling in terms of meeting this level of demand as we basically didn't get to travel anywhere and we started buying goods for the home and setting up our offices and those types of things. So his argument is we still haven't seen wage growth come through yet, as opposed to the US is seeing that and Europe is also seeing that. So there's some interesting stuff in that one. But he's consistent with his view, and that is that he doesn't believe that we'll see any interest rate increases throughout the course of 2022. The market still doesn't believe him. But until we see that wage growth, they are definitely digging in to want to see that wage growth. So I think that one is a good story. And on the property front, Bryce, we are starting to see supply now, especially now that Melbourne and Sydney are reopening and basically we've got sort of more mobility on the back of coming out the other side of lockdowns. We've definitely seen a spike in supply. So I just thought I'd quickly give you some updates in terms of where the supply is at from a percentage point of view, because there's some reasonable numbers here as well. But in the last sort of 12 months, new listings for Sydney are up 45%, for Melbourne 49%, for Brisbane 22%, for Adelaide 29%, for Perth 28%, for Hobart 19%, Darwin 86%, low base, Canberra 21%. So combined capitals over the last 12 months have had a 38% increase in supply. And I suspect that's also coming on the back of people sort of saying, great time to sell with the prices as they are. And we're just starting to see whether there's some demand fatigue starting to creep in with auction clearance rates starting to reduce a little bit. So it'll be interesting to see basically how we start the new year. So I'm looking forward to February when we finish our summer season and we talk about where we see demand and supply at that point. But I do think sort of areas like Melbourne, given there has been some new listings, in the last 4 weeks, there's been 898 new homes listed in Melbourne. So that just gives you an idea. So I suspect there'll be a bit of horse trading on property over the Christmas and New Year period, as opposed to most agents having a rest. Because if the demand is there and they've got supply, they'll continue to keep selling those, considering it's been an interesting last couple of years, Bryce.
Yeah, good one, Ben. There's also just a shout out to anyone who's buying in Queensland to remember that time is of the essence as a terminology up there. And there is a story recently of a couple who lost a $75,000 home deposit because of a bank stuff up. So just to let you know what time of the essence means, it's a contractual term that requires timely completion of a task. If timely completion of the task does not occur, then the other party to the contract will have rights against the defaulting party. So what does that mean? This couple put a $75,000 deposit down. The bank was not ready to settle. They made a request to see if they could extend the settlement. The vendor said no because the market was booming, Ben. And not only did they lose their $75,000 deposit, the vendor then put it on the market for an extra amount of money. And according to the report, was another $65,000. So instead of saying, well, here's your $75,000 back, they pocketed the 75 and the extra 65 as well, which was, in my mind, disgraceful. But
Un-Australian.
It's not right? And
it's not right.
But the bank thankfully has come to the party and helped this poor couple so they can buy. But their dream home, they've been saving for years and years and years, Ben, and they've got a Queensland contract where time is of the essence. They didn't settle because of a bank stuff up, and the vendor rescinded the contract, kept their deposit, and then took a new purchaser, sold it at a higher price. So, folks, you you need to be aware that time of the essence in Queensland is real, and we need to be on top of that and make sure that you are giving yourself a chance to make sure that you settle on time. And if there's any problems, let the banks know that this is an example of what can happen. So
yeah, and to that couple who decided to take the deposit and also make the other 65,
shame on you.
Yeah, poor form.
Not good. Mate, what a good episode for you and I to riff it. Next week is our last week, Ben. So before we pivot to the summer series. So that means that you and I have squeezed ourselves into a corner, because we've been telling our community that we're going to talk about what it means to have rapid price growth and what the options are. So you and I got a few catch-ups to do between now and next week, but that will be what we will be covering
New
next
framework.
week. We'll riff off a framework before we launch into our summer series, which we're so excited about everyone listening to, because there are some amazing stories that you will get to hear. But mate, big episode, big week coming up for you and me. But until next week, mate.
Knowledge is empowering, but only if you act on it.
See you next week, folks.
Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1. Because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you, because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management, so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. To thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up